Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fedex Corporation quarterly report. Fedex Corporation offers a wide range of businesses and services to its customers worldwide. At the core of its operations are transportation services, which include express shipping, freight, less-than-truckload freight, time-specific freight shipping, and small package ground delivery. In addition to these basic services, FedEx provides e-commerce and digital solutions that cater to the needs of online businesses. These solutions include DataWorks, printing and shipping management, packing services, and document and business services. The company also offers retail access for package transportation, making it a one-stop shop for customers' logistics needs. FedEx's logistics services are another key area of focus, with offerings that include air and ocean freight forwarding, cargo transportation, specialty transportation, customs brokerage and clearance, trade management tools and data, and door-to-door solutions. The company also provides third-party logistics and supply chain management solutions, such as inbound logistics, warehousing and distribution, fulfillment, contract packaging, and systems integration. Furthermore, FedEx offers a range of support services to its customers, including sales, marketing, administrative, information technology, and back-office support. These services enable businesses to focus on their core operations, while leaving the logistics and supply chain management to FedEx experts. Overall, FedEx Corporation's diverse portfolio of businesses and services makes it a leading player in the transportation and logistics industry. FedEx Corporation market capitalization of $85 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that FedEx Corporation holds a significant advantage in their industry. FedEx Corporation trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 2.88 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various factors affecting FedEx's financial performance. On the positive side, increased U.S. domestic package volume and higher yields for both domestic and international priority packages contributed significantly to revenue growth. Strong residential e-commerce growth in the U.S. domestic business and increased business-to-business demand in Asia Pacific and Europe also played a crucial role. Favorable exchange rates and successful implementation of transformation initiatives such as Network 2 and Federal Express International Air Network redesign further boosted revenue. Additionally, expansion of e-commerce services portfolio and higher net income levels indicate a positive trend for the company. On the other hand, macroeconomic conditions led to lower volume, resulting in a decline in revenue. Negative impacts from global trade policy changes also offset some of the gains from increased volumes and yields. Decreased fuel surcharges further contributed to the decline in revenue. Overall, these factors highlight the importance of adapting to changing market conditions and leveraging strategic initiatives to drive growth and mitigate risks. The net income of the company experienced a significant increase in Q3 2026 and YTD 2026 compared to the same periods in 2025. The net income rose by 16.4% in Q3 2026 and 18.3% in YTD 2026, indicating a substantial growth in revenue. However, the 9 months ended February 28, 2026 saw an even more impressive increase of 29.2%. This upward trend is primarily attributed to higher operating income, net of non-cash adjustments. Despite the overall increase in net income, there were some factors that contributed to a decrease in net income by $351 million in the 9 months of 2026. These factors include higher outside service contracts and professional fees, increased credit losses, and unfavorable exchange rates. However, these negative impacts were outweighed by the positive effects of higher operating income. The profit margins also showed an upward trend, with the operating margin for the Federal Express segment increasing by 0.6% in Q3 2026 and 1.1% in YTD 2026. In contrast, the operating margin for FedEx Freight segment decreased by 11.9% in Q3 2026 and 8.1% in YTD 2026. The business optimization costs decreased by $471 million from 2025 to 2026, which may indicate an improvement in profit margins due to cost reduction efforts. Overall, the company's net income and profit margins have shown a positive trend, driven by higher operating income and favorable working capital changes. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the latest figures, the company has achieved positive operating cash flow in both 2026 and the 9 months ended February 28, 2026. Specifically, the operating cash flow for 2026 was $14,419, while the cash provided by operating activities for the 9-month period was a substantial $5,660 million. These numbers demonstrate the company's efficiency in managing its day-to-day operations and generating sufficient cash to support its growth and investments. The company's debt levels have undergone significant changes over the past year. Initially, the total debt/long-term liabilities increased from $87,627 to $94,733 between May 31, 2025 and an unspecified date. However, a more substantial increase was observed when comparing the debt level at May 31, 2025, $70 million, to February 28, 2026, $211 million, resulting in a rise of $141 million. Furthermore, long-term debt saw a notable increase from $19.9 billion to $24.1 billion, representing a 22% growth. This substantial increase in debt levels is likely to have a significant impact on the company's financial situation. In terms of interest expenses, there was an increase from $582 million in 2025 to $631 million in 2026. Additionally, interest costs rose from $361 million in 2025 to $378 million in the 3 months ended February 28, 2026, and from $1,085 million in 2025 to $1,135 million in the 9 months ended February 28, 2026. Overall, these changes indicate that both debt levels and interest expenses have increased significantly over the past year. The financial performance of segments and regions varied significantly in the recent period. On a positive note, the Federal Express segment stood out with impressive growth, recording a revenue increase of plus 10.2% and operating income growth of plus 21.1%. The U.S. domestic business also performed well, driven by strong residential e-commerce growth. Internationally, the performance was boosted by increased business-to-business demand. In contrast, some segments and regions struggled to keep pace with the overall growth. FedEx Freight segment saw a decline in revenue and operating income, with decreases of 5% and 97%, respectively. International economy package yields also decreased, down 1% in Q3 and 4% in 9 million. Furthermore, total average daily freight pounds declined by 4% in 9 million due to the reduction of postal-related volumes. Overall, while some segments and regions showed resilience, others faced significant challenges that impacted their financial performance. Management's outlook for the company is one of cautious optimism. Despite expecting inflation and elevated interest rates to continue negatively affecting results, revenue growth is expected to continue into the remainder of 2026, driven by U.S. domestic service offerings. However, international revenue will remain pressured due to uncertain trade and geopolitical environment. To mitigate these challenges, management is focusing on business optimization initiatives such as Network 2 and Drive program, which are expected to deliver incremental $1 billion in structural cost reduction benefits in 2026. Additionally, the company is investing in strategic projects, including a spin-off of FedEx Freight Holding Company, Inc., and reducing costs through workforce reductions and aircraft modernization programs. Management is also actively managing capital allocation due to economic slowdown, with plans to repurchase additional shares of common stock subject to market conditions and liquidity needs. The company has flexibility to eliminate required contributions to its U.S. pension plan for several years, which will help maintain liquidity. Overall, management's strategy is centered around reducing costs, improving efficiency, and investing in strategic projects to drive long-term operating savings. The acquisitions made by the company include the purchase of several aircraft models such as the Cessna SkyCourier 408, ATR 72-600F, B767F, and B777F. These aircraft are expected to be delivered between 2026 and 2030. Additionally, the company has entered into a conditional agreement to acquire InPost SA, a logistics company valued at approximately $2.6 billion. The divestitures made by the company include a workforce reduction plan in Europe that will impact around 1,400 employees. The company is also planning to reduce up to 5,000 operational employees in international locations as part of its restructuring program. Furthermore, the company plans to spin off FedEx Freight through the capital markets, creating a new publicly traded company by June 2026. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company declared a quarterly cash dividend of $1.45 per share in February 2026, which was paid out on April 1, 2026, to stockholders of record as of March 9, 2026. The total amount paid out in dividends for 2026 and 2025 was $-1,028 million and $-1,008 million, respectively. In addition to dividend payments, the company has also been actively buying back shares. In the 9-month period ended February 28, 2026, the company repurchased 3.3 million shares for a total of $776 million. The total amount spent on share buybacks for 2026 and 2025 was $-796 million and $-2,517 million, respectively. These actions demonstrate the company's efforts to return value to shareholders through both dividend payments and share buybacks. Concerns about inventory buildup or supply chain disruption are evident in the recent reports. One key issue is the increase in expenses related to transportation, fuel, and maintenance, as noted on page 19. This suggests that companies may be struggling to manage their logistics costs, which could impact their ability to maintain a stable supply chain. Furthermore, lower shipments at FedEx Freight segment due to macroeconomic conditions affecting volume, page 30, indicate potential disruptions in the supply chain. The decline in shipments can lead to inventory buildup and strain on resources, making it challenging for companies to meet customer demands. Additionally, there is a mention of potential disruptions in global supply chains on page 46, which highlights the broader implications of these issues. With global supply chains already under pressure, any further disruptions could have far-reaching consequences for businesses and economies worldwide. That concludes the financial summary for Fedex Corporation. Feel free to comment below, and I will be happy to answer them when possible.